Hello and welcome to this session. This is Farhat, in which we will discuss the master budget. The master budget is referred to as the annual business plan. What it does, it establishes short-term performance target, typically for a year, and make sure that this budget is aligned, just like any budget, with the organization strategic objectives. So whatever we have in this budget, and we talked about budgeting, we had 3 or 4 recording prior to this one explaining the budget process. Now we are ready to prepare this master budget that should be aligned, one of its objective, with the company's strategic objectives. Now we're going to dive into the details of the budget. The component of a master budget would include an operational budget, which focuses on financial planning of the day-to-day operational activities. 2, a capital expenditure budget. 3, a cash budget, and the cash budget will include the inflows and the outflows that we generated from the operating budget and the capital expenditure budget. Now, once we prepare those 3 budgets, which we will do today in this recording, this is going to be a long recording, so embrace yourself. It will help us produce pro forma financial statements. Specifically, we will be producing the income statement and the balance sheet. So this is going to give us not only a budget, it's going to give us what would our financial statement would look like, a pro forma financial statement, including the income statement and the balance sheet, which is a futuristic financial picture of the company, which should be very helpful. Very helpful in a sense that it's a futuristic, it's based on the budget, so those financial statements are as good as the budget, and those financial statements are as good as executing the budget without any deviation. Let's go ahead and get started.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Since the end product is the pro forma financial statements, what I will start with is the balance sheet as of August 31st, X5. So this is the balance sheet at the beginning of the period that we are budgeting. So you will see this balance sheet later on once we are done with the cash budget. Remember, this is August 31st. We will be preparing the balance sheet as of December 31st, X5 by the end of this recording. But let's real quick go over what's on this balance sheet, because all these numbers will change and you need to understand where is the change coming from. Right now we have cash. This is as of August 31st, 20X5. I will not say this again because I'm going to go over the numbers. 8,500, account receivable 9,000, inventory 50,000, prepaid of 10,000, total current asset of 87,500, equipment and fixture 45,000, less accumulated depreciation equal to the book value of 31,500, total asset 119. For liabilities, we have accounts payable 29,400, commission payable 5,500, taxes payable 1,300, total of 36,200. We have common stock of 25,000, retained earning of 57,800. Total equity of 82,500, liabilities plus equity equal to 119, which is equal to total assets. So this is the starting point of this period. This is the balance sheet. Now the next thing we are going to do is we're going to look at the component of the master budget, prepare a master budget, and guess what? Prepare the futuristic or a pro forma balance sheet, and you're going to see how each of these numbers will change as we get toward the end. So it's very important, if you have a phone, take a picture of this phone, take a picture of this financial statement. Obviously, if you're a subscriber to Farhat Lectures, download the PowerPoint as you follow with me, because I'm going to be referring to these numbers. Now, account receivable is a new number. Now, inventory is a new number, and you will see how these numbers are changing. And obviously, in a computerized system, as you are making the changes, the numbers change automatically. Now let's take a look at the components of the master budget. As we said, one of them is the operating budget. The operating budget is a set of sub-budgets, maybe 10 to 12 sub-budget that forecast sales revenue, cost of goods sold, selling, and administrative expenses. And these budgets obviously will contribute to the cash budget, which support the preparation of the budgeted financial statement. So first, let's take a look at the operating budget, which is the longest. Specifically, when you start the operating budget, you start with the sales budget. This is important. Sales drive everything. Sales drive the whole budget. So without sales, you don't budget anything else. So if you're not selling, you're not in business, basically. Once you determine your sales, the next thing you do is you prepare your production budget. And under the production budget, you have to determine how much material you need, how much labor, and how much manufacturing overhead you need to produce what you need to sell. So starting from sales, then you do that. Now in this session, because this is going to be long as is, I skip over this step. So I summarize the step. I don't want to go into this long recording and look at direct material, direct labor, and manufacturing overhead. What I would do is I will create another example that only creating those three sub-budget, 1, 2, and 3. So for now, you're going to see in the example, I'm going to make it much easier for the production budget, for the sake of brevity, for the sake of capturing the big picture. So after we determine our production need, labor, manufacturing overhead, and material, we determine our cost of goods sold budget. Good. Then we need to determine our selling and administrative expense budget. Then we're going to take all these budgets and extract from them the cash payments and the cash receipts. Obviously, the only cash receipts is sale and everything else is negative. And include this information in the cash budget. We're going to see this in a complete example in this recording. That's good. So we finished the operating budget. After we finish the operating budget for the next 4 months, so our budget is for 4-month period, what we will do is throughout this way, as we are producing and selling, we might need a new piece of equipment. If that's the case, we have to include something we called capital expenditure budget, outlines a company's plan for acquiring or sometimes selling, but usually acquiring long-term asset. Therefore, within the budget, we have a capital expenditure budget. Capital expenditure means at some point we need to buy a new asset because as we're operating, as we're increasing sales, as we're producing, we might need an asset, maybe replace an asset, update an asset. We have to take this into account. And this capital expenditure budget will go into the cash budget as well. Usually, as I said, it's most likely we will be buying. It doesn't mean we may not be selling, but we might be buying. Then we have the cash budget. As I told you, this is the cash budget. What's in the cash budget, the operating budget, and the capital expenditure. We just figure out the cash inflows and outflows. Then we prepare the financial budget. The financial budget is derived from the cash budget. And we have a budgeted income statement and budgeted balance sheet. So a financial budget includes the cash budget and the budgeted financial statement, which is the income statement and the balance sheet. Now, obviously, we're going to start with beginning cash because we're going to have a beginning cash coming from, you guessed it, from the balance sheet. So when we start with cash, we know we have cash of $8,500. We have a beginning balance for everything, but we're going to end up with an ending balance once we are done. As I mentioned in the beginning, the sales budget will drive everything else. And as we saw, it's on the top of the budget. So what's a sales budget? So we have to create a budget for sales. It's a financial plan estimating total revenue for a specific period. Why is it important? As I mentioned, it drives the production budget, it drives the inventory budget, it feeds into the cash flow, it feeds into the budgeted financial statement. How do you create a sales budget? What's the process? Well, you can look at past information. You could look at historical sales pattern. You could look at competitor activities. You could look at your advertising and promotion budget and multiply that by 3, by 2, whatever your history is. You can look at market research. You could look at the overall economic condition. You could ask your sales team to estimate. You look at price changes or a combination of those, several combination of those. Now in this recording, I will keep it simple. I will give you sales, not the number of units. So I can make it a little bit more complicated where I can give you units, and the times the selling price to get you sales. But since we are not producing the production budget, I will give you only the sales number. And this is our sales budget: September 50,000, October, November, and December. So the budget we are preparing is for the 4 month September, October, November, and December. Now, we also need to know how much we will have in cash sales and how much is sales on credit, because when we make sales in September, the company will have a credit policy, and the credit policy state on average, not credit policy means they sell on credit, but the company would know on average how much of each dollar in sales is cash and how much of each dollar in sales is on credit. So the company anticipate 65% to be in cash and 35% will be on credit, and the credit will be collected the following month. So now we are ready to prepare our sales budget, also our cash receipts budget. For example, September is 50,000, of which 65% of it will be cash, and this cash will go, guess what? You're going to see this number embedded in the cash budget. When I look at the cash receipt budget, you're going to see this number. Now, what will happen to the 35%, the 17,500? This also will be embedded in the cash budget, but this will be in October cash budget receipts. In October, we're going to have sales of 60,000, 39,000 will be cash, 21,000 will be collected in November, so on and so forth. Now, when we get to December, we will be selling 75,000 in December. Of this 75,000, 48,750 will be collected in that month in December, and 26,250 will be collected in January. January will be January X6 the following year. What does that mean? It means this is the new number of account receivable. Why? Because we make the sales and we will collect this money in January the following year. Therefore, 26,250 is my account receivable that you will see if you want to mark it down or make a note of it. You will see it on the budgeted balance sheet. I'm telling you, but you will see it later, but I want you to see it here. The next thing we would look at is inventory purchases and cost of goods sold. I want to make sure you are comfortable with this formula, which is the cost of goods sold is as follows. Cost of goods sold, and you should have learned this in your Financial Accounting 101, is beginning inventory plus purchases minus ending inventory. This is cost of goods sold. What we're looking for is, in this formula, is purchases. So if we rearrange the formula, basically, just keep purchases on one side, it's going to be cost of goods sold plus ending inventory minus beginning inventory. Just rearranging the formula to figure out if we find purchases in terms of the formula equal to cost of goods sold plus desired ending inventory minus beginning inventory. Why this is important? This is going to tell us how much do we need to purchase. And what is that? Why is that important? Because how much we need to purchase will go into our negative cash budget, our cash payments. So that's why it's important. So let's take a look at what we are looking at here. So first, we need to estimate our cost of goods sold. And again, in this example, it's simple and it's going to be 65% of sales. So cost of goods sold equal to 65% times our sales. And usually companies will have this percentage pretty accurate based on historical data, based on their financial record. They would know what is cost of goods sold as a percentage of sales, 65%. It means their gross profit is 35. Then the company would like to have desired ending inventory 25,000 plus 75% of the next month cost of goods sold. So this company would always like to have 25,000 plus 75% of the following month. So let's take a look at what we have in September. In September, we have $50,000 of sales. We already know this number because the sales team projected this number. Then what we do to find cost of goods sold, we multiply it by 65%, and that's going to give us cost of goods sold for September. Now we need our desired ending inventory. Our desired ending inventory equal to what? Our desired ending inventory, 25,000 plus 75% of cost of goods sold of the following month. Well, what does that mean? It means you have to figure out what's your cost of goods sold for the next month. Well, the next month is October, so my cost of goods sold is 65% of 60,000, which is 39,000. So let's take 39,000 multiplied by 0.75. So if I take 39,000 times 0.75, that's going to give me 29,250, and I'm going to add to it 25,000 based on the formula here, plus 25,000. Now I have my ending inventory of 54,250. So now notice I am filling this out. So now I have sales, I get cost of goods sold, I get desired ending inventory. So if I take my cost of goods sold plus ending inventory, that's going to give me total merchandise inventory required, which is those two numbers together, which is total of inventory available for sale, we call it that. Then we deduct beginning inventory. Where do we deduct beginning inventory from? Beginning inventory is, let me show you, if you're wondering where this number is coming from, beginning inventory is right here, August 31st, 20 x5, 50,000 minus beginning inventory. And following this, let me go back and show you the formula that we're using, that we're manipulating, is this formula that we're working with. So make sure you're comfortable with this formula. And that's going to give us then, less beginning inventory, it's going to give us a budgeted purchases of 36,750. So this is the budgeted purchases. Now, of this amount, this is the budgeted purchases. How much of it it's going to be in cash? This is for September. We'll do the same thing for, you guessed it, the month of October. Sales times 65% equal to 39,000 plus the desired ending inventory, which will take 65% of November plus 25,000. Those two numbers, 39 plus 68,875, equal to total merchandise required or available for sale minus the beginning inventory. The beginning inventory becomes 54,250, which is from the prior month. The ending inventory becomes the beginning inventory. Then we get to our budgeted purchases, 53,625. We'll do the same thing for, you guessed it, November. We'll do the same thing for November. We have sales times 65% plus the desired ending inventory will give us total inventory available for sale, 120,062, less the beginning inventory, which is ending of the prior month. Then we will do the same thing for, you guessed it, for December. For December, we'll take 75,000 times 65%. Now for the month of January, I'm just going to give you cost of goods sold equal to 80,000. Just this is giving. So if I take 80,000 times 0.75 equal to 60,000 plus 25,000. So this is times 65 plus 25,000 will give us 85,000. And this 85,000 becomes our ending inventory for January. This is going to give us 85 plus 48,750 equal 133,750. Goods available for sale minus the beginning inventory will give us the budgeted purchases for the month of December. Now again, those are budgeted purchases. This doesn't mean cash unless we're paying cash that month. Sometimes we pay the whole thing in cash, sometimes we pay 50% in September, 50% in October, or 70% in September, 30% in October, or we could spread this over several months. It doesn't really matter. But the point is, this is the purchasing budget. So what we're doing here is we're looking for these numbers, and obviously we're looking for ending inventory, which will appear on the balance sheet. This is 85,000. We're also looking for total sales, which will be on the budgeted sales, total cost of goods sold. You're going to see all these numbers on the financial statement later on. Now we need to budget our selling and administrative expenses. Selling and administrative expenses represent forecasted non-manufacturing cost for the period. It has both variable and a fixed cost. The variable selling expenses are sales commission, delivery cost, bad debt expense. Fixed selling expenses are sales salaries, advertisement, and we have general and administrative, happens to be all fixed, administrative salaries, accounting and data processing, depreciation. How do we treat those? period cost. We're going to expense them as they are incurred. And hopefully we know this. We know this much. Now, we're going to include later on a pro forma financial statement that would reflect all these figures. Now, for this company, the monthly payroll includes salaries of $3,000, which is a fixed cost, plus sales commission equal to 10% of sales. So their salaries, part of it is fixed, part of it is variable cost, 10% of sales. So this is called a mixed cost, which has a fixed component and a variable component. Other monthly expenses are rent expense fixed, $2,500. Remember, we have to multiply everything by 4. Depreciation, 600 times 4. Insurance expense, 300 times 4. And variable miscellaneous, we have variable miscellaneous, different things, 4% of sales. Now we are ready to do what? Prepare our selling and administrative expense budget. Well, we said commission is 10% of sales, so we'll take sales times 10% to come up with commission expense, total of $27,500. For the miscellaneous expense, the variable component, 4% of sales. We'll take sales for this month times 4%, will give us total variable expenses. Then we have fixed expenses. We have salaries, notice $3,000 per month, rent expense fixed, $2,500 per month, depreciation $2,400, which is $600 per month. Same thing for insurance expense. And these are the total. Those what will go on the budgeted income statement. And here are sales, the budgeted sales, in case you're wondering where these numbers are coming from. I'm assuming you copy these numbers down. Now we are ready to prepare our cash budget, or let's take a look at the cash budget first. It provides details, projections about cash inflows and cash outflows. It's based on assumptions about cash collection and disbursement from other budget and inform management about the funds available for owner distribution, debt repayment, and investment. You have to have a cash budget. You have to have a cash budget because you don't want to get to a point where you are short on cash, where you cannot pay your suppliers or you cannot make a payment to your employees. So the cash budget will contain a cash available section, which is funds available from the beginning balance, and cash collection, which is what we started with, and the cash collection, which is the cash on hand. We're going to have a minimum always. Then we're going to have the cash collection, expected cash from current and prior sales adjusted for credit sales, of course, because this is only cash collection. We're going to have a section for cash disbursement, which is outflow for expenses and purchases. Then we might have to borrow money, or if we have extra money, repay the loan and have a desired cash level. So companies would often have to borrow money to maintain a minimum cash balance if they cannot maintain that minimum cash balance. So for Brightstar, cash flow consists of, for any particular month, 65% of sales of the current month and 35% of the prior month. Remember, we collect the current sales plus 35% of the prior sale because we're going to be collecting it this month. So on August 31st, we have $19,000 in receivable. When do we collect this $19,000? In September. Remember, we said we have this $19,000. If you look at the balance sheet, $19,000. Now, cash outflow would include inventory purchases. And how do we purchase the inventory? Now, I told you, of the purchases, we'll pay 30% upfront and 70% next month. So remember, we looked at our purchases, and I told you we might pay for the whole thing. We might, split it 50-50. Well, here what's happening, this company, they pay 30% in the month of the purchase and 70%. The 70% becomes accounts payable for them. Then they pay it the following month. Selling and administrative, those they will pay immediately. Selling and administrative, whatever incurred in that month will be paid in that month. Loan monthly payment up to $2,000 if a loan is taken to cover cash deficit. So how much do we pay in loans? Even if we have extra money, if the money was taken because we had a cash deficit, we pay it $2,000 per month. We don't want to pay the whole thing, $2,000 per month. August 31st, we have an accounts payable of $29,400. This is as of August. When it comes September, that is something that we have to pay. And we are planning a capital expenditure of $8,200 in October, $11,150 in December. That's the capital expenditure. We might have to pay additional equipment. We have to put this into our cash budget to make sure we have enough cash. And if we don't, we have to borrow the money. And the company wants a desired minimum balance of $12,000 at all time. If there's a deficit, the company will borrow cash in $1,000 increment and the interest rate is 10%, if they end up with extra cash, they will make up to $2,000 of monthly loan repayment. So they will pay it, even if they have extra cash, they don't want to pay the loan, they want to pay $2,000 off the balance. I would rather pay off the loan and keep my minimum balance, but each company is different. So let's take a look at the cash receipts first. So this is cash receipts. In September, we will receive 65% of the sales of September. So we're going to take sales times 65% in September. That's going to give us 32,500, and this is coming from August. This was the account receivable in August. The account receivable in August was 19,000. We collected this money in September. Now, for October, we will have two cash receipts as well. We're going to have the sales in October times 65%, and that's going to give us 39,000. Plus, whatever we did not collect in September, we're going to collect it in October, which the remaining of September, 17,500, and this will be the total cash receipts for October. We'll do the same for November and December. So the total cash for the whole budget is 267,750. Now let's take a look at the cash payment purchases. The cash payment purchases would have two numbers. One is this month purchases. We're going to take whatever the purchases for the month of September multiplied by 30%, and that's going to give us whatever that number is, equal to 11,025. And from the balance sheet in August, this is from August, if you look at the balance sheet, we have an accounts payable of 29,400 we paid in September. In October, the same thing. We'll take October purchases times, so October purchases times 30%. You can go to the October budget. That's going to give you 16,055. And what's left from September will be collected in October, 70% of the last month. And we'll do the same thing for November and December. So this is the total cash disbursement for the whole 4 months. Now the schedule of cash payment for selling and administrative. Commission are paid 100% of the month in question. We had a commission payable as of the balance sheet as of August 31st, 5,500. Miscellaneous expenses are 4% of sales. Sales and salaries and insurance paid in the same month. So commission payable, we paid the following month. So we have 5,500. This will be paid in September, and December will be paid in January for the commission. For the commission, we're going to have a commission payable. The year's rent expense were prepaid on January 1st. Well, that's good. We had a prepaid account. Now we're going to expense it. Here's the budgeted cash payment for selling and administrative. Commission expense, remember this 5,500 coming from August. This 5,000 coming from September because we pay the following month. The November 6,000 coming from October. December coming from November. And whatever we accrue in December will be paid in January. Okay, will be paid in January, which is 10% of sales will be in January. And we're going to see it on the balance sheet. Miscellaneous expense, we said we pay those miscellaneous expense immediately. So this is the 4% of sales. This is the total variable payment. Salaries all paid in the same month, 3,000 each. Same thing with insurance expense. Obviously, we don't have to make accommodation for depreciation. Depreciation is a non-cash expense. And remember the prepaid, the rent, remember the prepaid, we prepaid for it. We had 10,000 of prepaid. We're good with the prepaid. Therefore, this is our total payment for fixed expenses, total payment for variable, selling and administrative, total payment for each month, and the total is 49,700. You will see all these numbers on the income statement. Now it's the cash budget altogether. The first thing is the beginning cash and cash available, which is the beginning cash was 8,500 plus the cash receipt in September will give us cash available of 60,000. This number is coming from the cash receipt budget. Go back to the cash receipt budget. Cash payment. Now we'll look at the cash payment budget. Capital expenditure, nothing for September. Purchase of merchandise inventory, 40,425. This is coming from the cash disbursement budget. Then selling and administrative, 10,800, no interest expense. Then we have total cash payment of 51,225. Why no interest expense? We had no loan on the balance sheet. So if you look at the balance sheet as of August, we had no loan. Then what's our ending cash balance? Well, We started with 8,500, we added 51, we have total of 60. Then we have a cash disbursements of 51,225. Our ending cash is 8,750. Our minimum cash balance desired is 12,000. This is what we want to have. Well, we are short, deficiency 3,250. What are the rules for this company? If they are short, if they are cash deficient, they will borrow money in $1,000 increment to come up to 12,000. So they have to borrow $4,000. Now we have a loan on the books as of September of $4,000. We cannot pay anything off. Now we end up cash 12,775. We started October. Cash 12,775. Ending becomes the beginning plus the cash receipt. In October we have a capital expenditure 8,200 minus the purchases minus selling and administrative. Then we have to deduct $60 in interest expense. Now don't worry how we came up with the $60 interest expense, just assume it's $60 of interest finance cost. Total cash payment 60,773. Ending cash balance, which is positive cash minus ending cash, will give us $8,502. Again, we want to have 12,000. We are short. Again, another 4,000. We'll borrow another 4,000. Now we are up to $8,000 in loans, and our cash ending balance is 12,502. We start November 12,502 plus what we receive minus all the payments. Now we are at 26,055. We need 12,000. Excellent. So we are cash excess of the minimum of 14,088. What do we do if we have excess cash? We pay off the loan. We don't pay the whole thing off. Why? Because we want to keep extra cash on hand. When we have extra cash and we have a loan because we had a cash deficiency, we pay $2,000 at a time. So we're going to pay $2,000 in cash and we're left with $24,088. December, the same thing, $24,088 plus the cash receipts minus all the cash disbursement. Again, don't worry about the interest expense, just it's given to you. Again, we have extra cash. If we have extra cash above the 12,000, we have 8,000 extra cash. We only made a $2,000 payment. Remember, the loan was 8,000 and we made two payments of 2,000 minus 4. We are left with a loan payable or notes payable of 4,000. And our cash balance is 18,310. Now let's first prepare the budgeted income statement. The budgeted income statement will give us budgeted sales minus cost of goods sold. This is from the sales budget. This is from cost of goods sold budget, which is 65% of sales, equal to gross profit. Now we have commission expense, miscellaneous expense, salaries expense, rent expense, depreciation expense, insurance expense. All those from the various schedules. You know, the rent expense was prepaid, now we expensed it. So total selling and administrative expenses is 64,100. Gross profit minus total selling and administrative will give us operating income of 32,150. If we look at the cash budget, we have $270 in interest expense. That's going to give us 31,880 in income before taxes. Now we have to pay our taxes, and we're going to assume 21% tax rate. So if we take 31,880 times 0.21, that's going to give us 6,695 rounding. This number minus income before taxes minus net income will give us net income. Now this number, income taxes, we're not going to pay it now. It's going to be a taxes payable. It's going to be taxes payable. Now let's take a look at our old balance sheet. This was the old cash. Now we have a new number. We have a new number for receivable, new number for inventory, prepaid is gone. Cash expenditure, we made purchases, this is going to go up. We're going to add 2,400 of depreciation. Why? Because 600 times 4, that was the depreciation. Accounts payable will change, commission payable will change. Taxes payable we're going to add. We already have 1,300, we did not pay it, and we're going to add 6,695. Then we're going to have also a loan. Remember, there's a loan of 4,000 that we did not have in August. This did not change. And retained earning will be beginning retained earning plus net income minus dividend equal to the ending. We did not have any dividend. So let's take a look at the budgeted balance sheet. The budgeted balance sheet will be cash 18,310. I don't want to flip back and forth, but this is coming from the cash budget. This was the cash ending balance. Account receivable, I showed it to you. Inventory, I showed it to you. This is our total current asset. The prepaid is gone. The 10,000 was expensed. The equipment, we added 2 purchases and will end up to be 64,350. Accumulated depreciation, we added 2,400 to it. Our total asset is 178.10. Accounts payable, I showed you how we came up with this number. Commission payable, it was whatever we had sales in December times 10% will give us the commission payable. Taxes payable is the old taxes plus the new one that we accrued, and this is the unpaid loan of 4,000. This did not change, and retained earnings is beginning. Retained earning plus net income should be equal to this number, and this is going to give us equity of 107,985. If we take liabilities plus equity, will give us 178.10, which equal to total assets. So this is the budgeted balance sheet, and the best way to do it is if you want to look. That's why I kept the other balance sheet next in the next slide, so you can flip back and forth to see what happened to these figures, how they change, and how did we come up from here to here. It's all based on the budgeted numbers. So if the budgets are good, we would have a good idea. We'd have a good picture about the future. Hopefully it's a realistic picture because this looks good. We have more cash, more retained earnings. Now we have a loan, but we can easily pay it off. It's not a big deal. But this is what happened. This is what happened to this company, going from a regular balance sheet to this balance sheet. So this is the master balance sheet. Now we're gonna talk later about a stat. This is basically one scenario balance sheet. We're gonna talk about later on about flexible balance sheet and flexible budgeting and variances, just in case things don't materialize exactly as we expect. We have what if budget or flexible budget, but that's a separate recording. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice exercises, lectures. That's going to help you do what? Be prepared, whether you are studying for your CMA exam, CPA exam, cost accounting, managerial accounting, any other accounting, finance course or professional certification. Invest in yourself. Farhat is always here to help.